Hi guys, this is Sewanga from Millionaire's Journey. We are continuing with our trading course. Last video we talked about support and resistance. It was a long video, 25 minutes explaining support and resistance. Today we are continuing. So let me tell you the topics that we covered. We covered support and resistance. We covered minor resistance and support and major resistance and support. I explained how to find support and resistance. I explained the top 2 trading strategies of support and resistance. I explained support and resistance advantage and disadvantages. And remember, on the strategies, I hope you didn't just go and start trading the strategies, as we will have a series of videos explaining a strategy. A strategy is not just that you buy at the support, you sell at the resistance. No, there's a lot to look for. You have to look for candlesticks, you have to look for patterns. You don't just look for a level and then you just assume that the price will reverse because the previous chart was reversing. No, it doesn't work like that. So today we are continuing. We'll be talking about a trend line. What is a trend line? We'll be explaining the 3 market phases. We'll be explaining how to identify a trend line. We'll be explaining 2 trend line strategies. I wrote trend line strategy, and I will be explaining that whether a trend line reliable or they are not reliable. So let's just continue with it. So what are trend lines? Trend lines are easily recognizable lines that traders draw on a chart to connect a series of prices together. The line is then used to give a trader a good idea of a direction in which investment value might move. A trend line is a line drawn over highs or under lows to show a direction of the price. Trend lines are usually representation of support and resistance in any time frame. They show direction and speed of price and also describe patterns during period of price contraction. In a downtrend, the trend line is above. On an uptrend, the trend line is below. So this is the uptrend because the overall move is to the upside, and this is a downtrend because the overall move is to the downside. And this line that you see here is what we call a trend line. Let me just redraw it again. This is what we call a trend line. And do you see what the price is doing when it approaches that trend line? Do you see how the price reacts to that trend line? Look how it reversed here and how it reversed here. So it works like a support and resistance, but not this time. It's not horizontal, it's rising or it's falling. So trend lines are drawn over highs and low to see the direction of the price. So we draw trend lines to see where the price is going, and if it keeps on creating the lower lows and the lower highs, we know that okay, we are on. And if it creates lower highs and lower lows, it creates a lower highs, it means that the price is going to a side, because you see this low and this low is higher than this low. That's why I'm saying a lower high, and also this low is higher than these 2 lows. That's why I'm saying lower highs. So you see that the price is pushing to the upside, and as traders we can trade this. If the price came here, you just and came here again, you just put a line. When it comes here for the 3rd time, you're just looking to buy. I will explain this when I'm explaining the strategy. Same applies when you are going to the downside. You see here is a 1, 2. On the 3rd touch, you can start looking for selling opportunities. So trend line, they assist us. They are like support and resistance, but this time the line is falling or the line is rising, and you can have a strategy based on this. If you are using it correctly, you can have a full strategy trading this if you are trading it correctly. In a downtrend, the line is above. You see in a downtrend, our trend line is above the price movement, so it keeps on pushing the price to the downside. It keeps on pushing the price to the downside, you see. So in an uptrend, the trend line is below. The trend line is below. It keeps on pushing the price to the upside. It keeps on pushing the price to the upside. So this is the concept of trend line, and lucky enough we have a book that talks about trend lines and how you can use them to have a full strategy, and I'm very excited about that. So let me show you the three market phases. We have three market phases, and these phases are: we have a downtrend, we have an uptrend, we have a consolidation, which is also known as a ranging market. So these are the three market movements. An uptrend describes the price movement of a financial asset when the overall direction is to the uptrend. This is a uptrend. As you can see, the price is creating low, higher low, low, higher low, higher high, and higher high. So the price, it keeps on going higher. The lows are higher, the highs are higher. It just keeps on pushing to the upside. In an uptrend, each successive high and low is higher than the previous one. As you can see, each and every high is higher than the previous high. So high, higher, higher low, higher, higher high. The price keeps on pushing up. Started from the low and kept on pushing up. That's an uptrend. And on an uptrend, we can just put a trend line and look for trading opportunities. When this price drops and comes here, you can look for it to create another higher low and push up. You can just wait for the higher low and the push up. A downtrend refers to a price action of a currency that moves lower in price as it fluctuates over time. While the price may move higher or lower, downtrends are characterized by lower highs and lower lows over time. That's what this means. We have a high, and then we have a lower high, and then we have a low, we have a lower high, we have a lower low, we have a lower low. The price keeps on going lower. Everything is going to a downside, and we can just put a trend line above that price and look for trading opportunities if the price comes and touch that trend line and continue to push to the downside, right? So the market is said to be ranging or consolidating when the price of a financial asset is making the same highs and lows a number of times. The most common identified range in market is when the price hits the same support and the resistance level 3 times. So if the price, let me say we have support and resistance, and the price can't break out of this support and resistance. It came in, it hit the resistance, it pushed to the support, resistance, support, resistance, support, resistance, support. This market is ranging. There is no uptrend, there is no downtrend. It's just a sideways movement. It's just a sideways movement. Whereas when you look at the uptrend, it's just an up movement. It's pushing to the high, and the downtrend is pushing to the lower side. But the ranging market just moves in one straight support and resistance, and that's why it's called to be ranging. So the best way to trade the market, you can either trade an uptrend or a downtrend. Attempting to trade the ranging market is very risky. It needs a lot of skills which take time to develop, but it's tradable. So let's continue. Now that you know the three market phases, let's continue and exploring how to identify trend lines. First thing to know about drawing trend line is that you need at least 2 points in the market to start a trend line. Once a second wing or low has been identified, you can draw a line. So let's say you are on an uptrend and you see something like this. You can just draw your line. You can draw your line because you need at least two swings to confirm an uptrend. You need at least 2 points in the market to start the trend line. You see point 1, point 2, and then you can just simply put your trend line. You can simply put your trend line and then keep on monitoring if the price will respect that trend line. So as long as you get the 2 rising points, you have a trend line. Same applies as say a downtrend. You need 2 points to start a downtrend. So you can have, say maybe you have this point and this point. You can put a line and wait for price to come to this point and start trading. So you need at least 2 points to confirm that you have a trend line. As you can see here, here is point 1, here is point 2, and then there's a line, and then the line was drawn, and then these are the following points. Same here, point 1, point 2, and then we are looking for trades on point 3. So you need at least 2 points to start a trend. You need 2 points. You can't just draw the price can move like this, and then you can't just assume that now we have a trend, because the price can just come back and just continue to move the way it wants to move, and you just drew a line without having a clear point. So you need at least 2 points to draw a trend line. Please practice these things on the chart. Just look for them on your chart during your own time and practice these things. There are 3 very important keys to drawing an effective trend line. The higher time frames will always produce the most reliable trend lines. So start there and work your way down. You remember we talked about time frame. There's 4 hour, there's day, there's week, there's monthly, there's 5 minutes, there's 1 minute, there's 30 minutes, and 15 minutes. So what this statement means is that at least start analyzing on a daily time frame and go down to 4 hour and keep on going down to lower time frames, because higher time frames tend to give reliable trend lines. Most trend line you can come across will have some overlap from the high or low of a candle, but that's what important is getting the most touches possible without cutting through the body of a candle. So this can be a candle and this can be your trend line. The minute the candle closes below that trend line, there are high chances that the trend line has been broken. touches possible without cutting through the body of the candle. If it cuts through the body of the candle, that means that trend line is invalid, or it's broken, right? Never try to force a trend line to fit. If it doesn't fit the chart, then it isn't valid. You can never force a trend line to fit on the chart. If it doesn't fit, it means you don't have a trend. Just leave that chart. Just leave that chart until it gives you a clear trend line. Don't force it. So important points: look for trend line on higher time frames, and then do not force trend lines. Never ever force a trend line. It will end in tears. Now here are two trend line strategies. We have a trend line trading strategy and a trend line breakout strategy. The trend line strategy utilizes the trend as an either support or resistance. A downward trend line it's a resistance, and an upward trend line it's a support. Simply draw a line connecting two or more highs in a downtrend or two or more lows in an uptrend. Two highs in a downtrend, two lows in an uptrend. In a strong trade, price will bounce off the trend line and continue to move in a direction. As you can see, this is a strong trade. The price kept on bouncing off these levels, and also here the price kept on bouncing off. It bounced off here, and then when it came back, it broke here. I will explain that. Therefore, traders should only be looking for interest in the direction of a trend for higher probability. If we have this clear trend line, you can never look for, if you have this clear downtrend, you can never start looking for buys unless this trend line is broken. If you're trying to buy this pair before this trend line is broken, you will have some serious trouble. And then also here, if you can never try to sell this pair unless the trend line is broken, and now the price is showing the signs of dropping. So that was the first strategy. You are trading with the trend. You are moving with the trend. The second strategy is the trend line breakout. This strategy is based on an idea that when the price breaks a trend line, the trend has potentially changed, right? As you can see here, let me show you here. We had this trend line, and then as soon as the price broke on these levels, the direction changed. You see, so that's the idea behind the trend line breakout strategy, is that when the price is when the trend line is broken, we start looking for sell. By broken, I mean close below the trend line. If you had a trend line and the price and the candlestick closed below that trend line, that means the trend is broken. Closed below, it was a trend line, it broke that trend line and closed the candlestick below. That means that trend line is broken. So what this means is that if you spot a price break downward trend line, then that means that an uptrend has started, so you should look to buy. If the price comes and break this line here, that's a good time to start looking for buys. The exact opposite happens when an upward trend line is broken. When it breaks like this, you start looking for sells. So these are the two strategies, and the books that I was talking about go deep in details about these strategies, and they can be profitable if you are using them correctly. They can be very, very, very profitable if you use them correctly. So let's see our last slide. Are trend lines reliable? Well, the answer to this is simple. If you draw a trend line correctly, they can be very accurate as they can be accurate as any other method if drawn correctly. Now, unfortunately, most forex traders don't draw them correctly. They try to make the line fit the market instead of the other way. People don't draw the trend lines correctly. They try to make the trend line fit the market the way they want it to do. They don't actually draw the trend line the way the market is presenting it to them. So that's it for today's video, and thank you for watching up to this very end. Ask questions and check our previous videos in our Google Classroom, and keep on learning. I'm happy with the progress, so thank you very much. We'll meet on the other video.